Have you ever made that classic mistake of investing at the wrong time, only to watch a stock's price drop afterward? Or maybe you got caught up in the excitement of a rising market without thinking about the consequences? I bet you have, and you're not alone. Most investors make this mistake, and believe me, it costs millions every year. But the good news is, you can avoid this trap, and the best example comes directly from Warren Buffett. What many investors don't realize is that the biggest mistake you can make in the market is being driven by emotion. Thinking that an investment will keep rising simply because it's been rising is an easy trap to fall into. Buffett, the greatest investor of all time, would never do that. And that's what we're talking about today: how to identify this mistake, how to avoid it, and what you can learn from Buffett's investment strategy to ensure you make more rational and smarter decisions moving forward. Ready to change the way you invest? Stick with me, because in today's video, I'm going to teach you how to avoid this mistake and transform your investor mindset for long-term success. Many investors make a common mistake that ends up costing millions of dollars annually. And the worst part is that they often don't realize they're falling into this trap. The mistake is making impulsive decisions driven by emotions, like fear and greed. This leads many to buy stocks when prices are high, thinking the rise will continue, and of course, they sell at the bottom, desperately trying to minimize their losses. When you make decisions based on emotion, you lose your rationality, and with it, the opportunity to make solid, profitable investments. The problem is that this mistake is almost invisible until the investor looks in the rearview mirror and sees how much they've lost. This mistake costs much more than just money. It costs time and opportunities. Investing without a clear strategy and without analyzing the fundamentals leads the investor into a spiral of bad decisions. Over time, this can mean losing focus on long-term goals. The biggest mistake of all is thinking short-term and constantly chasing quick profits. And while new investors might be tempted to follow this logic, long-term success requires much more than a race for temporary numbers. This is where a solid investor mindset comes into play. Instead of making decisions based on emotion, it's crucial to focus on deep analysis and the fundamentals of companies. This means looking ahead, asking tough questions, and never rushing decisions. Over time, you'll realize that investing rationally, with a long-term focus, will be much more rewarding than trying to time the market. Warren Buffett, the Oracle of Omaha, is known for his ability to spot opportunities that others miss, and part of his success lies in avoiding the most common pitfalls that trip up many investors. One of the key reasons Buffett has been so successful is that he recognized early on the importance of not getting swept up by market emotions. Unlike many investors who react impulsively to market movements, Buffett takes a calm and measured approach. He knows that the market is often driven by short-term noise, and it's in these moments that most investors make their costly mistakes. Buffett's strategy is built around the idea of investing in companies with strong fundamentals, businesses that can weather any storm. Instead of looking at the short-term performance or trends, Buffett focuses on the intrinsic value of a company. He asks himself, will this business still be profitable 10, 20, or 30 years from now? That long-term focus is what sets him apart. Buffett knows that investing isn't about timing the market, it's about identifying companies that will continue to grow and generate value for years to come. Most investors get distracted by the market's fluctuations, but Buffett has made it clear that focusing on the fundamentals and avoiding emotional decision-making is the key to success. By sticking to this philosophy, he has been able to build his wealth steadily over decades. So, the next time you hear about a hot stock or feel tempted to act impulsively, just remember, Buffett's success didn't come from jumping in and out of investments, but from staying calm, focusing on the fundamentals, and being patient. All right, now let's get to the real meat of the matter. In today's video, I am going to reveal the exact mistake that most investors make and how you can avoid it. This mistake is so common, yet so dangerous, that it costs millions each year, and it's something you can easily sidestep with a little guidance. The key to avoiding this mistake is simple: stop letting emotions drive your investment decisions. Whether it's fear of missing out, FOMO, or the anxiety of seeing a portfolio dip, these emotional triggers can push you into making rash moves. But with the right strategy, you can outsmart this trap. What you need to do is take a step back, take a deep breath, and remember that investing is not about chasing the latest stock craze. It's about being strategic, patient, and focusing on companies that have solid, sustainable growth. Instead of worrying about the next big stock or trend, focus on finding investments that align with your long-term goals. I'll walk you through exactly how you can start using a rational, fundamentals-based approach to investing so that you can build wealth without falling into the emotional roller coaster that many investors face. So, if you're tired of second-guessing your decisions or jumping on every hot tip, this video will give you the tools you need to avoid the most costly mistakes. Stick with me, and I'll show you how to invest like Warren Buffett, rationally, calmly, and with a clear focus on the future. Ready? Let's dive in. It's a classic mistake. Investors often look at a stock that has had a strong upward trajectory and think, if it went up before, it's bound to keep going up. But that's a dangerous way of thinking. The reality is that past performance does not guarantee future results. Sure, a stock might have surged in the past, but that doesn't mean it will continue to do so. In fact, relying on past performance as an indicator of future success is one of the most common mistakes that investors make. It's easy to get caught up in the excitement of a stock that's been climbing, but that excitement can cloud your judgment and lead to poor decisions. The real problem here is that this kind of thinking is based purely on emotion, fear of missing out, the thrill of the chase, or the hope that the success will continue forever. But as Warren Buffett often says, price is what you pay, value is what you get. Focusing solely on the stock's past price movement without considering the value or fundamentals of the company can lead you into dangerous territory. Instead of looking in the rearview mirror, you need to focus on what really matters: the long-term potential of the company. So, before you jump into a stock just because it's been on the rise, ask yourself some hard questions. Is this company fundamentally strong? Does it have a competitive edge? Will it continue to grow in the long run? When you shift your focus away from past performance and towards the underlying value of the company, you'll make more informed and rational decisions that lead to long-term success. We've all seen it before: the emotional roller coaster that many investors go through. When a stock is soaring, the excitement is palpable, and it's hard to resist the urge to jump in. But this is exactly when the trap is set. People see the stock at its peak and think it will continue climbing, so they rush in, buying at the top. But then, when the market inevitably corrects itself, or the stock takes a dip, panic sets in. Instead of holding on to the investment, many sell at the bottom, desperate to cut their losses. This buy high, sell low mentality is one of the fastest ways to lose money in the market, and it's almost entirely driven by emotion. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This statement holds a powerful lesson. When everyone else is buying frantically because a stock is climbing, that's when you need to take a step back and ask yourself, is this really a sound investment, or are people just getting caught up in the hype? Likewise, when others are panicking and selling off their holdings, that's when you should be looking for opportunities to buy undervalued stocks. The key is to keep your emotions in check and make decisions based on the fundamentals, not the short-term market movements. Buffett's approach is simple but effective: invest when others are fearful, and stay calm when everyone else is excited. By doing this, you avoid falling into the trap of buying at the top and selling at the bottom. Instead, you'll be able to make rational, long-term investment decisions that serve you well, even when the market is full of uncertainty and chaos. Warren Buffett has a name for this trap. He calls it the rearview mirror illusion. It's a simple but powerful way to describe the mistake that so many investors make. The illusion is that they look at past stock performance as if it were a reliable indicator of future success. But just as you can't drive forward while only looking at the rearview mirror, you can't successfully invest by focusing solely on what's happened in the past. Sure, past performance can give you some context, but it doesn't tell you the whole story. In fact, it's one of the biggest traps in the market. Investors who get fixated on the past often fail to see the bigger picture and miss out on more rational, future-oriented opportunities. Buffett has often warned against this trap, urging investors to focus on the fundamentals of a company rather than its past price movements. The rearview mirror might show you where the stock has been, but it doesn't tell you where it's going. So, when you find yourself getting caught up in the excitement of a stock's past performance, take a step back and ask yourself, what is the company doing today? Does it have a clear path to continued growth? The key is to look at the present and future potential of the company, not just what it has done in the past. The rearview mirror illusion is a classic emotional mistake, and it's one that Buffett has mastered avoiding. By keeping his focus on the future and not getting distracted by past performance, he has been able to build a legendary investment career. When you start thinking like Buffett, you'll avoid this trap and be in a much better position to make smart, rational investment decisions. When it comes to making sound investment decisions, past performance isn't nearly as important as you might think. While it's tempting to look at how a stock has performed in the past, it's much more valuable to evaluate the financial health of the company behind the stock. This means looking at things like revenue growth, profit margins, debt levels, and the company's overall business model. A strong company with solid financials is more likely to continue performing well in the future, even if its stock price has had ups and downs. So, instead of fixating on the past, focus on the present and the future by digging into the fundamentals. Buffett emphasizes the importance of investing in businesses with a durable competitive advantage, meaning companies that are able to consistently generate profits over time. He's not interested in companies that are just riding a short-term wave of success. Instead, he wants to see a company with strong leadership, a clear path to future growth, and a business model that can weather economic storms. By looking at these factors, you'll be much better equipped to identify companies that have the potential to deliver consistent, long-term returns. So, the next time you're considering an investment, ask yourself, does this company have the financial health to continue thriving in the long run? Don't just look at the stock price history. Take a deep dive into the company's fundamentals. By focusing on these key indicators, you'll make smarter, more informed decisions that lead to long-term success. One of the most powerful questions you can ask yourself as an investor is, will this company remain profitable in the next 10, 20 years? It may seem like a simple question, but it's one that many investors overlook. In the rush to chase quick profits, they often forget to think long-term. But if you want to emulate the investment philosophy of Warren Buffett, this is a question you need to ask with every investment decision. Buffett himself has famously said that he doesn't just look at a company's current performance, he wants to know whether it will continue to generate profits for decades to come. And to answer that question, you need to look beyond the short-term trends and dive into the fundamentals. When you focus on the long-term potential of a company, you're looking for qualities that will allow it to thrive over the course of many years. Does the company have a strong competitive advantage? Does it have a proven ability to adapt and innovate? Is it in an industry with long-term growth potential? These are the types of questions that Buffett asks himself when evaluating a business. The goal is to find companies that will continue to generate cash flow and profits over the long haul, regardless of short-term market fluctuations. So, when you're thinking about investing, take a moment to imagine where this company will be in 2 decades. Will it still be relevant? Will it still be making money? By taking this long-term perspective, you'll be better prepared to make investments that are not just profitable now, but will continue to deliver value well into the future. Warren Buffett's investment strategy revolves around one key principle: focus on businesses that are predictable and stable. This may sound too simple, but it's actually a fundamental aspect of Buffett's success. He doesn't chase after hot trends or invest in companies that are riding a wave of short-term excitement. Instead, Buffett looks for companies that have a consistent history of performance and a business model that shows long-term sustainability. For him, it's all about finding businesses that generate steady cash flow, have a strong market position, and can weather economic downturns without falling apart. When you're evaluating companies, think about their stability. Do they have a reliable product or service that people need, no matter what the economic conditions are? Are they in a sector that has consistent demand? Buffett tends to favor industries like consumer staples, utilities, and insurance businesses that aren't dependent on fads or short-term trends. His strategy is about reducing risk and focusing on investments that will perform steadily, year after year, rather than gambling on uncertain, high-risk opportunities. By focusing on predictable and stable businesses, Buffett ensures that his investments are well-positioned to thrive in both good times and bad. This approach takes the emotion out of investing and allows him to sleep at night knowing his money is working for him in businesses that are fundamentally sound. So, when you're considering where to invest, ask yourself, is this business predictable and stable? If the answer is yes, you may just be looking at a future Buffett-style winner. One of the most important lessons Warren Buffett teaches us is to avoid investing on impulse or based only on price history. Too many investors get caught up in the excitement of stock price movements and end up making decisions driven by emotion rather than sound analysis. Whether it's the fear of missing out, FOMO on a stock that's soaring, or the panic of selling when prices drop, these impulsive actions rarely lead to success. Buffett's strategy is built around avoiding these emotional triggers. Instead, he emphasizes that investors should make decisions based on the fundamentals of the business, not the stock's recent price action. When you're investing, you need to take a step back and think about the long-term prospects of the company. Is the business stable? Does it have a strong competitive advantage? Is it capable of growing and adapting over time? By focusing on these key questions, you can avoid making rash decisions that are driven by fear or greed. Buffett teaches us that true success comes from making rational, well-informed decisions based on solid research, not by chasing trends or reacting to short-term market fluctuations. If you want to avoid falling into the trap of impulse investing, make it a habit to focus on the fundamentals of the business you're considering. The stock price may be tempting, but it's the company's overall health and future prospects that will determine whether your investment will pay off in the long run. By sticking to this principle, you can build a portfolio of solid, well-researched investments that will grow steadily over time. Now that you know the biggest mistake most investors make, it's time to take action and change the way you approach investing. Are you ready to stop chasing trends and focus on solid, long-term investments? Remember, investing isn't about trying to time the market or follow the crowd. It's about understanding the fundamentals, doing your homework, and making rational decisions. By adopting Warren Buffett's mindset, you'll be more prepared to avoid the emotional traps that lead to poor choices. So, what are you waiting for? Start looking beyond past performance. Dive deep into the financial health of companies and focus on those that have the potential to thrive over the next 10, 20 years. Think about your future, not just the here and now. And if you found this video valuable, don't forget to subscribe to the channel, hit the notification bell, and stay tuned for more tips that will help you become a smarter, more successful investor.